Hello, everyone. Welcome to this exclusive webinar from DoctorNews. My name is Erica Alexander. I'm the Associate Publisher, and I'm excited to bring this very important webinar to you guys today. I'd like to take a moment to introduce our presenters today from Foster Group. First will be Ross Polking. He's the lead advisor in business development. And also joining us is Kent Kramer. He's the Chief Investment Officer. Ross and Kent, can you take a moment to introduce yourselves?
Yeah, we sure can. Thanks, Erica. Hello, everyone. It's a pleasure to be speaking with you all today. As Erica mentioned, my name is Ross Polking. I'll cover the front end of this conversation today. And as Erica again mentioned, I'm a lead advisor and business development coordinator with Foster Group in my 13th year now. And Kent, who will speak with us here shortly, he does serve as our Chief Investment Officer. He's been at the firm even longer than I have and the real brains behind the operation. So I know you'll enjoy his insight here shortly. Kent and I are both shareholders here at the firm, and Foster Group's been around for 30 years, essentially serving as an independent fee-only investment advisory firm for individuals and organizations. And it's important everybody understand that we don't sell a thing. We're all salaried employees. We don't work on commissions or push products. We're fiduciaries. So we just enjoy educating our clients. We have 1,100 clients spread across the country, and nearly 400 of those are medical professionals like yourselves. And this really gives us an excellent opportunity to understand the financial needs of physicians. So in the end, our focus is really to help people make good decisions with their money and avoid costly mistakes. And so getting into the presentation here, certainly one way to avoid such mistakes is to be mindful of where your advice is coming from. And some of you may be familiar with this face or maybe even more so his voice, but there are plenty of outlets willing to offer up recommendations on a daily or minute-by-minute basis. And Jim Kramer, again pictured here in his Mad Money program on CNBC, he's a fairly well-known character, has a lot of purported insight about stocks to buy and sell on a daily basis. And Jim's he's a smart guy. He graduated from Harvard. He ran a hedge fund. He's an accomplished author, amongst other things. But I think it's important that in instances like this, we take a step back for a moment and look at things from a macro perspective when we are consuming Jim or others of his like, and really ask ourselves the question of, is his advice applicable for me? Does Jim know my situation, or his antics or his screams more driven by CNBC's paycheck and the advertisers supporting his program? So, another smart guy, you'll see his picture here in a second. David Swensen, he's served as Yale University's Chief Investment Officer since '85 and runs their endowment of nearly $30 billion. And you can read through his quote there, but David, he's not a fan of Jim specifically. Now, he's pointing out really the fallacy of Mad Money and programs like it and the misdirection it provides to so many investors who follow their recommendations. And what I found interesting were some of his quotes, or at least the verbiage he uses. And first is, he notes extraordinary credentials. So, David clearly points out that Jim's a smart guy. He's not taking anything away from that, but he follows it up with using the phrase shamelessly promotes. So he's pointing out the fact that Jim's being compensated by someone other than those who are receiving his recommendations. He's being compensated by a media mogul to provide entertainment, not prudent financial advice. And lastly, there, key term is inappropriate. So noting that the advice Jim shares is not in line with the audience's needs, simply because Jim doesn't know what his audience needs, nor could he. So, moving on, this presentation isn't at all about the fallacies of Jim Kramer. He's an easy target. He's easy to pick on. We can all get a laugh out of it. But he again serves as a good example of what's wrong with using financial press as a resource for recommendations. And again, to be reminded that their compensation is tied to drawing more viewers and readers and clicks on the internet. because sensational and bad or even opportunistic news sells. That's what draws people in. And so the question then arises, why do investors take action when presented with this news? And, a few reasons are listed there: the fear of missing out, the need to act now. So that thought of, well, if I don't do something right now, immediately the opportunity is going to be gone. Greed and the get rich quick thought process or opportunities. And finally, their loss aversion. Behavioral science has proven that we as human beings feel losses much more intensely than we do successes. So that fear that's struck from bad news can often lead to bad decisions. So this next slide, the question is there any value at all, right? I mean, our world is permeated with stock forecasts and predictions and market suggestions as to what direction things are headed. And, the question is, should we indeed act when we read or watch something that offers up some buying or selling insight? And I don't want to steal Kent's thunder. He'll dive into this principle a little bit later, but evidence-based investing suggests passive investment approach. And when I say passive, I'm talking about doing something other than trying to buy what's hot and what's not, or avoid what's not. Passive investing is more of a buy and hold strategy, being fully diversified. It's proven to be more successful in the long term than really the aggregate results of so-called professional investors. So again, the formula: stay diversified, stay invested, keep costs low. Pretty simple formula. And this idea of timing. Timing is a super dangerous deal. If you recall what happened the evening of the 2016 presidential election, overnight futures markets were getting crushed, and those investors who went running for cover, those were the ones who actually lost. You fast forward to the end of the day, and things had settled down, and then the following year of 2017 turned out to be an incredibly strong year of market returns. And present day now, we hear a lot of rumblings that a recession is looming, and we've been, and in our industry at least, we've been hearing this since the last one even ended. So sooner or later, somebody's going to get it right. But this time, the defining predictor is this idea of an inverted yield curve when short-term interest rates are higher than long-term rates. And the trouble is history doesn't really provide precedence that an inverted yield curve brings about a recession at a particular inflection point. There's no point that says here it comes or this is going to happen in X number of days. So those trying to time the market and avoid what may or may not happen simply risk missing the continued movement of the market, in an upward direction more so than a down. So it stands to reason you must use discernment when digesting financial information. And because this next slide will evidence that even the best make mistakes. This is a picture and a quote from the Oracle of Omaha, Warren Buffett, and myself being a resident of Omaha. We hear from him often, and he's an incredibly successful and wise businessman. And I love listening and reading anything from Warren, but he's also living proof that even the best miss when making predictions, as evidenced by his Kraft Heinz purchase. Mr. Buffett, he can afford mistakes of this magnitude where the rest of us can't. So it makes sense then when he strongly advocates and talks often about how most investors really, they ought to simply use a low-cost, diversified portfolio of index funds for their personal investments. This next couple slides here evidences, again, just kind of the perils of trying to time and individually security select and follow financial press and the recommendations being made. Just consider how fast information moves today. Certainly at speeds faster than we have time to react and thus profit from. And, these two charts, literally the moment Berkshire, so Warren Buffett's organization, agreed to the buyout of Heinz, the share price shot up while the trade volume just exploded. And then in following suit there, as years progress, this next slide will show that, Warren and his shareholders, they were not rewarded for the risk taking in this instance as the stock price really fell over the course of time. So holds true, always has, always will, that investing hindsight is 20/20. If only knew then what we know now. So I'm going to take us back again, just the topic of the conversation here on this next slide, and really the issue of news sources and how to interpret the information they're providing. And the listing here, A through D. Is this information? Asking yourself as you consume it, are these outlets, are these news sources reporting reliable information, or are they simply providing commentary? Are they advocating for a particular stance or investment, or again, is this just entertainment? And I would advocate for the fact that the answer is probably E. All the above, and the trouble is we never know which is which. So I'm going to get ready to toss it over to Kent and remind everybody, we all need to be careful when consuming opinions from the financial press. Okay, so that's really the moral of the story here. And while there won't be a big flashing caution sign every time Jim Kramer is screaming at you, or you pick up a copy of the Wall Street Journal, wherever you're at on that spectrum, it's important to remember the endless sources of news and recommendations are not specific to your personal situation and plan. And those providing the recommendations are rarely, if ever, held accountable to being right. And conflicts of interest, as we talked about, readily abound. And relying on this information can significantly dampen one's probability of success. So, Kent, I know we talk about probability of success a lot, and this next visual really drives home that point, doesn't it?
It sure does, Ross. Thanks. That's kind of going through those beginning just examples of things that can lead people maybe into bad decision making. What we really want to do when we think about making investment decisions is, what can I do to increase my probability of success? Ultimately, at the end of the day, that's what we hope for. We've got, many of us maybe have a longer runway on how to make investment decisions, and at the end of that runway or along the way, we want to know what steps we can take to be successful, to raise that probability of having a good outcome. And a couple things, these are just some pieces of information that we think are pretty persuasive. This first one talks about how important it is to remain diversified in the way that we think about investing across our portfolio. And all this picture is saying is, if you had owned basically all stocks in, let's say, the U.S. stock index, like the S&P 500 or the Russell 1000 from 1994 to 2017, so a fairly long time period, your average annual return for owning all of those stocks would have been 8% a year. If you would have missed just the top 10% of performers each year, so in other words, you had most of the stocks, but you didn't have all the winners, or the whole universe, you missed the winners, you would have cut your return in half. And if you really would have been a bad decision maker, if somehow you would have missed the top 25% of performers each year, you would have been down actually a negative 4.4% for each year. So the point of the slide is, there's lots of different ways to try to select securities, but really if you want to have a very high probability of at least getting the return of the market, which has proven to be a very good return for people, you can just own the whole thing and pretty much guarantee through a diversified portfolio that you will get the return of the market. In the same way as we think about diversification of holdings, this next set of quotes talks about something that I call time in the market. So not only do we have a chance to make security selections, do I want to own the whole market, but we have a decision to make about when we want to be invested. And what these kind of statistics are showing here, and what Larry Swedroe wrote about, is it's very hard to time the market to know when to be in and when to be out. And the thing about these quotes that I find so compelling is, just like those, if you miss a few stocks, you can miss the return of the market. These statistics would say if you miss a few months, you can miss the return of the market. The second bullet there, the best 92 months, just 8.3% of the months, provided an average return of 10% or more than 100% of the annualized return over the full period. So again, this was just hey, you kind of must be present to win when it comes to market returns, because they tend to come in relatively short bursts, and you need to be there to catch them when they do come positively. So again, we just think from a diversified standpoint, you want to be fully diversified across a large group of securities, and at the same time, you want to be invested across a large swath of time. You want to stay invested, as Russ said earlier, because we think that really gives you a better chance of success. So before we leave kind of some of these red flag things, I just want to summarize our red flags that we talked about just a little bit in thinking about this conversation with you today. The first one is, if you hear someone talking about a short-term kind of investment approach, you want to be really careful of that. Historically, short-term, trying to make day after day decisions as though what you do today, you're going to undo tomorrow and then undo again the next day. that just leads to a very low probability of a successful outcome. But that's the way that the news media is set up to keep your attention. They're trying to give you day-to-day things to do. And I saw a study recently, kind of harkening back to Jim Kramer. I think in any given year, Jim will make somewhere between 5,000 and 6,000 stock recommendations. So you can imagine trying to keep up a portfolio of that kind of, the number of recommendations and the turnover necessary to keep that thing in operation. You really want to be careful when conflicts of interest start to show up. You want to think about who's paying who for the investment advice, for the investment information that you're receiving. Oftentimes in the financial press, it's not the investor who's paying for the advice, it's someone who's advertising an investment. They're trying to get you to make a decision to do something, or just trying to get your attention so they can sell some advertising. That's a real conflict of interest. They're not giving advice necessarily for your benefit, but in order to benefit their business, which is keeping their show or their magazine in publication. Another one that we like a lot is this idea of lack of co-investment. If someone's talking about an investment that they themselves are not participating in, that is a red flag. You want to be very careful when there's no co-investment, when somebody doesn't have skin in the game with you in terms of how they're approaching that thing. And then as Ross mentioned, anytime you hear someone appealing to biases, and we all know when we're being sold something, that sense of being manipulated, we should kind of feel the hair on the back of our neck start to rise up a little bit. But if someone's really coming hard against this fear of missing out, like, hey, if you don't do this today, you're totally going to miss out. That's just generally not true for investors. If they're appealing to a recency thing, like this thing just happened yesterday, if you don't get in today, you're going to miss it. Maybe they're fitting a narrative. People do this all the time in the news. They say, well, the reason that the market is going down is because the Federal Reserve said they might raise interest rates next week. That's just one factor among thousands of factors that are influencing what's happening in the market. But they've got a narrative that they want you to believe, and they're simplifying it. And then this last one gets a lot of people in trouble, I think. It's catastrophizing. And this is what advertisers do all the time. When I get calls from investors, and they will ask, hey, are you worried about the dollar going to zero? Are you worried about U.S. currency or U.S. budget deficits? And my question usually comes back is, well, how much cable news are you watching? There'll be silence for a minute, and then there'll be kind of a chuckle. And I'll say, you could probably do yourself a big favor by just stopping. Just stop watching that. Because those advertisers are trying to create fear of catastrophe in order to get you to do whatever it is that they want you to do that's going to bring money to them. So if that's what we need to do to hit, not do what the mute button needs to hit, what do we need to do? What positive steps can we take? And we think we've got a few for you here today. They're pretty actionable. So on this next one, we're just talking about how you kind of develop an investment philosophy that you can really live with on a day-to-day, year-to-year basis. And the first thing that's really important is you have to have a personalized plan. You need to know what you need, what you and your family needs to have happen. That is the first and most important thing that an investor can do, is to understand what their money needs to do. Because ultimately, money is a means to an end, and unless we know what the ends are, it's hard to know which portfolio is going to be successful. The second thing we think is you need to embrace uncertainty. The world that we live in is full of uncertainty. It doesn't matter whether it's weather, politics, sports, or investing. We think that it's much better to prepare for a range of potential outcomes rather than trying to predict which exact one is going to happen. The third one is harnessing markets. Markets, broadly defined, as we kind of looked at there, we're just talking about the U.S. stock market a few slides ago. Those markets have provided really good returns for investors who can think long-term and remain long-term owners. And those markets have provided good returns through what we would think of as historically difficult times for people who've stayed in them. This fourth one we're going to have a little fun with, but I think it's one that's really important, is you want to avoid predictable disappointment. There's lots of ways to invest money. Some are more successful than others. Some, however, are predictably disappointing. There are some things when you look at just the history, the study of people who've tried to do things a certain way, they've just been predictably disappointing in terms of underperforming what someone could get by just participating in the market. And we'll talk about a couple of those in terms of equating short-term results with skill or not diversifying. And then the fifth one is this idea of advancing with science. And I feel like in talking to an audience of medical professionals, of physicians, this is like preaching to the choir, right? Because this is what you do when you think about how best to treat a patient. You want to bring to that patient kind of the state-of-the-art science, the thing that's been tested, that's been evidence-based, that's proven to give a reasonable result, that's proven to produce better patient outcomes. I've had back surgery 3 times, and I can tell you that my back surgeon, I have an incredible amount of respect for him, because when there was better science on the kind of the future projection that he could see coming, he'd say, let's wait for this to develop, because I think this is going to be the thing that's going to be successful for you. And this last surgery that I had has been extremely successful because we waited for the science to advance to address the problems that I have personally. I'm really appreciative of that physician because he chose to advance with science, and it accrued to my benefit. This last bullet, I just throw it in there. If you must, try to create a balance between investing for the long term and what I'm going to call speculation. I laugh with the number of investment clients of the firm. We talk about them having a casino account. They just want to have something that they keep control of and can make a decision once in a while if they hear of a good company or an idea. But maybe a 90-10 split on how you think about your money between long-term investment and speculation might be something reasonable to consider. Okay, so let's talk about, other than having this personalized plan, the first thing that we think is super important is that we recognize that markets are unpredictable. They are predictably unpredictable. There's a couple quotes here that I like. Barry Ritholtz is a financial journalist and an investor himself. He was at a meeting of investment professionals recently, and I think the thing that he said that these professionals reiterated to him was the math of the markets is such that you will occasionally look stupid. That is just the way it's going to be. There are going to be some bad days in the market and some good days. And then the second quote is from another person who I like to listen to. But the quote there is this idea of investing in any asset with uncertain cash flows requires an element of speculation about the future. In other words, when we think about investing in anything, there's a degree of uncertainty as to what's going to happen tomorrow or next month or even next year. And we have to just accept that, because part of our investment return that we get is what we agree to take a certain amount of risk, we agree to take on a certain amount of uncertainty in exchange for the potential of return over long periods of time. And so in a way, that unpredictability is part of the source of our return. The next thing we talk about is this idea of how do I participate or harness the entire market? And here I'm going to, like Ross, kind of appeal to Mr. Buffett from Omaha, because what he says in a lot of different ways I think really makes sense for investors. And in his most recent letter to shareholders, for the Berkshire Hathaway shareholders, he talked about how he and Charlie Munger and the whole Berkshire family really has benefited from this tailwind of the U.S. economy and the U.S. market. In other words, what he's recognizing is, yes, they've made some good security selection decisions and certainly been smart along the way, but they've been making those decisions in the environment of an upward sloping experience. In other words, a lot of investors, if you had just invested in the U.S. stock market over that same period of time, you would have had a very positive experience. And what he's saying is, hey, that positive nature of market returns, that robustness of the U.S. stock market is a tailwind that investors, if they will just kind of raise the sail and catch that wind, they can have a positive experience. And he notes in that last kind of paragraph there that that tailwind has been in place through some very difficult periods in the U.S. economic environments, whether it's periods of inflation, high interest rates, we've had wars along the way, we've had a president resign, we've had the 2008-2009 financial crisis. Those things were all bad periods of time for stock markets, but for investors who were invested the whole time right through them, overall, they had a very, very positive experience. So we want to accept uncertainty, we want to harness the market, and then we want to be careful to avoid these things that we're going to call predictable disappointments. And Ross kind of alluded to this idea that on average, this approach called active management is actually a below average approach to getting in better investment returns. And there's been lots of work done by academics on this, but one of the things that it comes back to is basically when you engage in an active management strategy, you're actively trading your portfolio, whether through security selection or timing or whatever, you are generating costs inside the portfolio. And what happens is those costs become higher and higher the more active the strategy gets, and as those costs get higher, it just creates a hurdle to actually achieving a market return. So we're going to look at a couple things here, but this idea of trying to outperform the market, what we would say is, hey, rather than try to beat the market, let's make the market our ally. Let's kind of join that thing and make it our kind of our co-laborer, if you will, in getting better investment returns. Because when people try to beat the market, and this next slide talks about something called the SPIVA US scorecard, and this is the Standard & Poor's company. They put out a scorecard that basically measures professional investment managers and their success at beating a benchmark. And what you'll see in these next few slides is, while these managers are very highly paid, very intelligent people, that for the most part, they're not successful in meeting or exceeding the market benchmark that they're being measured against. The third bullet on this slide just talks about, better than 90% of those professional managers over a 15-year period fail to outperform their benchmark. That's not a great rate of success. So that's where we get this predictable disappointment. The probability of picking the right manager 15 years ago, who's going to be in that 10% increment that outperforms, is really tough. And the next slide is kind of a different graphic of that same kind of data set. Here you see how many managers started 15 years ago. This is the period ending in 2017, but 15 years prior to that, how many managers started at the beginning of the period, a little bit over 2,800. And then at the end of 5 years, 82% of them actually were still in business. If you kind of roll that forward, again, looking at that 15-year period, after 15 years, only half of them were still in business. And of those ones who started, only 14% actually managed to achieve their benchmark or be successful in the sense of providing the market's return to their investors. By the way, if you think it's something, well, hey, let's just pick those 14%, this next picture talks about how hard it is to do that. One of the things that we hear all the time, and I'm sure that you are very tired of hearing as investors, is that past performance is no guarantee of future results. Well, this is the kind of study here. Again, this is just an academic study of some data of why a quote like that is so important for you to think about. Because people who think, well, I'm just going to look at who's performed well in the past, and that's where I'll put my money for the future, because if they've done well in the past, the likelihood they'll continue to do well in the future. What this chart would show is, well, that's really not true at all. Those investment managers who achieved a top 25% return, in other words, in terms of the universe of managers that they were a part of, hey, this 25%, they were the top 25% of performers. What happened in the next 3 years? Well, you can see a lot of different 3-year pictures there, but what you see is, for the most part, of the managers who achieved a top 25% performance in one 3-year period, less than 1/3 of those managers continued to achieve a top 25% performance in the next 3-year period. Because persistence in terms of investment performance, it just doesn't seem to be indicated by past performance, which is a little counterintuitive, but the competitiveness of the marketplace tends to make it very difficult to continue to outperform over multiple periods. Something else that's affecting that performance is this next picture here, where we talk about turnover. I mentioned briefly this idea of costs or something to pay attention to. You can use trading costs and turnover as kind of a proxy for how much an investment strategy is really costing to implement. And this picture is really showing something very similar. Again, over longer periods of time, those kind of 10 and 15-year periods, the higher the turnover strategy, in other words, the more trading activity that's going on in the portfolio, the less likely it is that that portfolio or that manager is going to outperform their relevant benchmark. So what these pictures and studies are showing us is that, hey, this kind of traditional approach or thinking about active management through security selection, market timing, and the turnover it takes to implement that, it doesn't seem to be a high probability way for investors to succeed. So what is a high probability way to succeed in those managing our portfolios? And this last point here that we're going to make, this idea of advancing with science, here the point is, hey, since the late 1950s, there have been dramatic advances in financial and economic science. And so we as investors, and you as physicians, you do this all the time, I'm sure in your work, you're looking at journals and publications, trying to decide, okay, what of these advances in science and medical science do I want to implement into my practice for my patient's benefit? In the same way, good investment managers, good financial planners should be doing the same thing. We should be reading the most recent research put out by academics around the world, the things that are being tested, they're being peer reviewed, the evidence is being looked at, out of sample, in sample, all those kinds of things. And when we find the things that really are valuable, they give high probabilities of increasing a better investment experience, we should be applying those things to our portfolio. I'm going to give you a couple ideas here on how you might do that yourself. The first one is you want to know your short and intermediate term cash requirements. For years and years, really for decades, institutional investors, particularly pension funds, have used something called asset liability matching in thinking about how to allocate their portfolio between growth assets and more conservative preservation assets. They do that because they know a certain amount of money is going to need to leave their portfolio every year to meet the cash flow needs of retirees in the case of a pension. In the same way, as you get close to retirement, you want to have, this is why having a financial plan is so important, you want to have an idea of how much money you're going to be needing from your portfolio every year in order to live in the way that you've become accustomed to or kind of with your goals in the future. And you want to know how many years in advance you're going to need that money. So as people get close to retirement, we say, hey, for the money that you know that you're going to need in the next 2 years from your portfolio, that money should be invested in very short-term, high-quality fixed income and cash-like instruments. Because that money, $1 today, better be $1 plus interest tomorrow, because you're going to need it and because we know that the future is uncertain. So that those cash flows in the next 2 years are basically your liabilities. You're going to need money for those things. In years 3 through 8, so let's look at the next 8-year period, those years, same thing. You want to have relatively conservative, high-quality bond portfolio. They can be a little bit longer maturity. But again, what you're trying to do is pick assets that match your liabilities. And so for liabilities you have in the next 8 years, the best matched assets, those assets that are most likely going to be worth $1 and some interest or some growth, those are fixed income and cash assets. Beyond the 8-year period, you need growth to beat inflation, and that's where you create that growth portfolio, usually constructed with equities. So how do you think about that equity part of your portfolio? Well, the second bullet is we think you structure your growth assets for much longer term success. Diversifying across global markets is important because capital today can go anywhere instantly. As well, you want to think about what financial science is saying about, are there certain parts of the market that I should emphasize above others if I want to increase my expected return? And it turns out that there are parts of the market that tend to have higher expected returns. Two very simple ones to, I think, understand are emphasizing lower price or value stocks in your portfolio, as well as smaller companies in your portfolio. And we're going to look at a way to do that, a very simple way. One of the things I don't like when I listen to certain presentations, they don't give me any actionable thing to do. It's more theoretical and I don't know what to do with it. So this next picture, I'm just going to show you a very simple way to apply what's called factor investing. And you're probably reading about that today. If you're reading about investing at all, people talk about smart beta or factors or premiums. They're all basically talking about the same thing. What they're saying is there are quantitatively grouped sets of securities that historically or statistically have higher expected returns than the broad market. And so what I'm going to talk about here is, well, how would you actually construct a portfolio that leans into kinds of stocks that have higher expected returns, and what would that result have looked like, let's say, over the last 20 years if you'd done it? So portfolio one is just the Russell 3000. That's the top line in the graph here. And all that is saying, hey, I'm going to buy the Russell 3000 index, which is the 3,000 largest publicly traded companies in the United States. And I'm just going to own them as my market neutral portfolio. This would be a truly passive way to be a U.S. stock market investor. And by the way, you can do this at a very, very low cost. The folks at Vanguard and some of the exchange-traded fund providers, BlackRock and others, have made it very, very cost-effective to invest this way. If you look at the Russell 3000, just at the end of last year, about 9% of the Russell 3000 was consisting of small companies. So remember, if I say factor-wise that small companies tend to outperform large over long periods of time, that 9%, those small companies have tended to have better performance than larger companies in the Russell 3000 or than the Russell 3000 as a whole. In the same way, about 1/3 of the Russell 3000 are represented with value companies. So 1/3 of those 3,000 companies, or about 1,000 companies, kind of align with what we're going to call a value metric. They have a better book-to-market ratio. These are the kind of companies that Warren Buffett would say would be better to buy because basically they're on sale. Okay, so that would be the market neutral. And if you look at the 20-year return of that Russell 3000, it's done a little bit better than 6% a year with a standard deviation, which is kind of a measure of volatility. Now, the second line is just what I'm going to call the double, small, and value portfolio. I'm not doing anything fancy here at all. My goal with this portfolio is, again, I just want to use market indexes to construct a portfolio that has twice the weight in small companies and about twice the weight in value companies. So I'm going to lean or tilt my portfolio so that it gets a double helping, if you will, of small and value versus market neutral. In order to do that, now I need 3 indexes to construct that thing. You can do it different ways, but I just use these 3. So my portfolio now has 15% of the Russell 3000. It's 69% invested in the Russell 1000 value. And the Russell 1000 value are large U.S. companies that basically are on sale. They have a higher book-to-market ratio. And then the Russell 2000 value index is taking that same kind of valuation metric, but I'm also now looking at just small companies. Of the Russell 3000, the smallest 2,000 of that group. And I'm weighting my portfolio just the way it is there, 15, 69, and 16. And you can see just from a simple change in the portfolio here by tilting the portfolio to small and value, I've increased my 20-year annualized return going from 6.2 to 6.9. And my risk, my experienced volatility in that all stock portfolio has gone down from 14.9 to 14.7. We haven't made any security selection decisions. We haven't made any market timing decisions. This is a very cost-effective, very straightforward portfolio strategy to implement. And if you look at a different version, a different chart of kind of these same results, what you can see is over the last 20 years on this growth of wealth chart, which is the next one, you can see those 2 lines really climbing steeply over time. It's not that there's not volatility in both portfolios. There is, because they're both stock portfolios. But if our goal in our growth portfolio is to grow this thing aggressively over time, well, let's go ahead and advance with science and say I'm going to tilt into those small and value-ish companies. I'm still going to maintain my long-term investment approach. Still going to keep my costs low. I'm not going to engage in any market timing. But by just using those simple, well, they weren't simple for the guys who were working on the projects at the universities, but when we think about it today in terms of the application of that, it's not difficult for investors to do. It might be hard behaviorally to stay in the portfolio at times, but in terms of actually getting access to the components of a portfolio like this, it's very straightforward. So that's just a pretty straightforward, I think, very actionable item that people could do if they wanted to think about evaluating their own portfolio in light of their weightings to small and value and how it could be done differently. So I'm just going to summarize here some of the things we've talked about, and then we're really interested in your questions and as we get done here, and Ross and I are both happy to hang around and answer those things. But just to summarize, the most important thing, again, that we think a person can do in terms of getting to investment success is to have a personalized plan. That's just critical. You need to know what the portfolio is supposed to do, what are the ends you're trying to meet, and then that portfolio can become a means to those ends. Remember that uncertainty is just part of the investment environment. People act, and especially if you're watching television or reading, they act like they know exactly what's going to happen tomorrow, or they can explain what happened today. That's just not accurate. There are lots of things that go into what happens in the market on a daily basis. And the idea there that there's going to be some kind of certainty about the future, or even a certainty about explaining exactly what happened in the past, just very, very unlikely, and most studies would say that's just a fruitless exercise. Harnessing markets, make markets your ally, not your enemy. You're not trying to beat them. As we've seen, if we can cooperate with markets and get the market-like return in the investments we choose to make, we can be tremendously successful. You want to avoid predictable disappointments. Those are things that overpromise and underdeliver. And then really, again, I know I'm preaching to the choir again, but you want to advance with science. And there are scientific advances that are happening regularly. You want to take those things with a grain of salt. I'm sure you hear advertisements all the time about which medication or procedure is the greatest thing ever. And maybe those things haven't been tested quite enough yet. But there are things that the research institutions and research universities in the United States and around the world are discovering around investment in economics and finance that can be applied to your portfolios with success. So with that, I'll just kind of say thanks for letting Ross and I have this opportunity to share some of the things that we think are important. And Eric, I guess I'll turn it back to you to moderate any questions that are coming from the group.
Thanks, Ken. I appreciate that. Yeah, we have a few questions that have come up over the course of the presentation. The first question is coming in from Craig. He asks, are either of you familiar with VestorVest and their grading system of over 8,000 stocks? If so, please share your thoughts. VestorVest.
You know, I have to say I'm not familiar with that one. I know there are lots of grading systems out there for stocks, for individual stocks and companies. I think what I'd probably say there is, because there are so many, what I would be looking for is not just one source of information, but I'd be comparing whatever it is that group is saying or writing about in those individual stocks with a couple other sources, just to make sure that I'm, kind of getting, I'd say, a well-rounded approach to any individual company that I'm thinking about investing in. Tons of great sources. They may very well be a really good one. I'm just not familiar with them.
Okay. Next, Nina asked, are you saying that investors can't beat the market?
Ross, you want to take that or me?
I'll start and then I'll turn it back over to you, Kent. And that is a great question, and certainly I think the premise or the walk away from this presentation, if we didn't say anything more, might be your conclusion. And that's not necessarily the case, but the thing you have to remember, and Kent did a good job talking about it as well, is risk and reward are related, and so our focus is, as an investor who's focused on the long term, is really pairing that right amount of risk and reward and knowing, hey, what we might use it too much, but the line of, highest probability of success, and knowing what, stands to reason and stands to prove better for us over the long term, as opposed to hoping we get it right, and in taking that undue amount of risk associated with it to get there. But Ken, I know you have some thoughts on this one too.
Yeah, I do. I think it's a question that's asked regularly, and what I'd say there is certainly people can and have beaten the market. One of the big things you have to kind of ask and answer with that question is, what do you mean by the market? As we just showed in the last couple of slides there, by kind of tilting the portfolio towards small and value stocks, in a way, that portfolio did beat the market if you define the market as the Russell 3000. What we did is we really took the market and carved it up into sub-markets. So we looked at small value companies and large value companies as markets themselves. So there is a lot of good evidence out there around this idea of factor investing or thinking about the market in pieces. What we find less likely, especially today, is that lots of people can do individual stock picking or market timing and successfully beat the market. You saw the statistics on even professional investors who try that as a whole group. They've been relatively unsuccessful in making that happen.
Yeah, just the last comment on that too, Ken. I think anybody, depending on the time period that you want to look at, I think you can argue for any particular philosophy or stance if you look at it in a shorter enough view. So you can simply start with the S&P 500 and break it down into certain increments and purport or suggest that, hey, all I need to do is this because it works. Well, it might have worked for those 6 months or 12 months, but yeah, that's really where you get into apples and oranges and trying to really stretch out that period of time, not knowing really, hey, when is the time to only do this versus only do that. And so just be wise and careful on that.
Okay, the next question is from Tom. He said you started off the call with a lot of information about what not to read, what not to watch. Can you recommend any shows or sites or publications where you can get good financial news and advice?
Why don't you? Kent's a voracious reader, so I've got 4 little kids at home, so the only thing I'm watching is Disney Channel, so I'm probably not a great resource on that right now. But
yeah, shamelessly here, one thing I'd tell you is you might check out the Foster Group website. We try to, when we find things that we think are worth sharing, we post them up there. And I think at the end of this, Erica's going to have our website address, and we curate a bunch of content there, some of it written by our advisors and some of it we just repost. But I do think, for example, Vanguard, as an investment company, they publish a lot of material that I think is very helpful for investors. Some of it's, if you really want to go deep into economics or financial markets, they have those kind of things there. If you have interest in what's happening with current news, they have some good commentary there as well. In terms of books to read, I thought about this question kind of in preparation for our time here, and one of the ones that I really like and I actually give to a lot of people is entitled Winning the Loser's Game by Charles Ellis. And Ellis was a teacher and an investment manager for just years and years and years. And he talks about this idea of, the loser's game is trying to beat the market, so how do you win at that? And he uses a tennis illustration. The idea there is, if you're an amateur tennis player and you're trying to hit winners all the time, the likelihood is that most of your shots are going out as opposed to in. So if you're playing someone, it's better off just to try to get the ball back. Just keep it in play. So his point there is, if you want to win in a game where most people are going to lose, just keep the ball in play. Well, keeping the ball in play is staying invested in the market. A couple other ones that I like. One's called The Investment Answer, and that one you can pick up on Amazon as well. It's by Dan Goldie and Gordon Murray. And then one that's kind of a fun one is called Playing the Winner's Game, so opposite to Charlie. But it's written actually by Larry Swedroe. And Larry, if you follow him on the internet, he's a great writer as well. I appreciate and read pretty much everything Larry writes.
Thank you. I didn't realize you were going to get some reading. I've made a list here. I guess I have one final closing question personally. What do you think is the most important thing investors should pay attention to when making these kinds of decisions?
Go ahead, Ross. I heard you breathing in. You ready to go?
Yeah, right. Yeah. Well, in full disclosure to everybody, our Foster Group, we have 2 offices, and I happen to be in Omaha, and Kent's in our headquarters in West Des Moines, Iowa. So we can't quite look at each other and wink, wink, nod, nod as to when that's going to take it. Yeah, Erica. Yeah, that's a great question and a good way to wrap it up. And I'd say, as much as we've talked about investments and financial press and recommendations and just all the science around it, I'd say the answer to that question is really to take it back to what does an individual need their portfolio to do, and how does that work in concert with their financial plans. So we see this often with clients of ours, specifically physician clients who come to us early on in their career, and they've got debt, they've got high goals, they stand to earn a lot of money, and again, they simply want to make good decisions and be in a trajectory to meet their goals long term. And it's real easy for someone in our industry to just take whatever it is they're planning on saving or take their investment portfolio and say, hey, do this, right? You need a whatever percent return. Well, how do you know that? What do you know you're aiming for if you don't have a plan in place to even determine where you want to end up? So a lot of that, the answer to that question really starts at the very beginning of, as simple as documenting assets and building out, just verbalizing really what are your goals and who do you want to benefit and how do you want to take care of kids and how do you want to manage debt, and all those pieces in combination then will inform how a portfolio ought to be structured. And it's at that time then you really get into the nuts and bolts of that. But I would just say again, it starts and ends with the planning piece.
Yeah, I totally agree with that, Ross.
Well, very good. Thank you, both of you, for providing such great insight today. I think we all learned a lot. If any of you in the audience want to reach out to Foster Group for any follow-up questions or request a personalized plan, I've put Ross's email address up there as well as their phone number and a link to the website. You'll also be receiving a follow-up email with this contact information as well. We really appreciate everyone's time and attention today, and we wish you a good week. Thank you.